Good evening.
Good evening.
Right. Okay. So today, so you all participated for the last Saturday session. No, is there anyone who joined today?
I participated.
Right.
I don't know what.
So anyone
I
who
also
joined today?
I joined today.
Sorry, you joined today.
Yes, yes.
All right. Right. Okay. I think since a few of you have joined today, I will I'll discuss the introduction right quickly. In fact, only very few things we discussed last day because we had a short session. We had just a little more than 1 hour session. Mainly, we discussed about the program and very briefly we discussed about the overview of this module, right? Therefore, so we'll quickly discuss the overview of this module, right? And after that, we can move to the main topics, right? And as as you know, in this program, so the two modules you do, financial management and the financial statement analysis. The financial management is the more quantitative module, right? But this is also the easiest module because once you understand the concept, when you practice these these calculations, you can easily do that, right? And so we discussed the main points related to this module, right? So we discussed, right? Okay, I'll start from the beginning because since a few of you joined today, we discussed the introduction to financial management because financial decision important for any organization, right? We discussed, we know whatever the nature of the organization, they all need to make finance decisions. They all need to make finance decisions, right? So we need to have a clear understanding about what are the key finance decisions that the organizations have to make, and what is the objective of making these financing decisions, right? What are the objectives of making financing decision, and what are the key finance decisions that any organization should make, right? So there are different forms of business organization, from the most basic level, sole proprietorship, then partnership, then company. So when we consider these different types of business organization, so you all know when they start the business, what is the long-term objective? What is the long-term objective of the organization, of any organization? The long-term objective is to
Maximize wealth.
Maximize value, right? So that's why in finance we use the term, the objective is the maximization of owner's wealth. And right, so mainly we focus on companies, right? We focus on companies because who are the owners of a company? Who are the owners of a company? Shareholders are the owners. Shareholders, right? Therefore, that's why this objective is mainly known as the maximization of shareholders' wealth. Owners.
The shareholder is an internal stakeholder and external stakeholder.
Internal. In fact, the shareholder means he's an owner. So he's the owner. That means when we internal, yeah. Because when we buy shares of a company, right, because we know when you want to invest your money, you have two options. You can invest in equity instrument, you can invest in debt instrument. If you invest in equity instrument, what is your position? You become a
shareholder, owner of the business.
Owner of the business. You get certain percentage of ownership. You get a certain percentage of ownership. So which means, right, you are an owner. So that means internal state, right? The word you use very important, stakeholder. We use the term that broad term stakeholder, which include so many parties. Stakeholders means, right, all the parties that have some stake, some interest about the organization. Some are internal parties, some external parties, right? So then if you invest in debt instrument of a company, then what is your position? If you invest in debt instrument, you become
the investor.
You can share, you maybe share investment, you invest in shares or you invest in debt instrument, right? You can invest in shares or invest in debt instrument like debentures, right?
Yes.
Because in Sri Lanka, corporate bonds not there, only treasury bonds there, right? But debt instrument like debenture. So whatever it is, you become investor. But if it is shares, you share investor means you get ownership. You become owner. But if you invest in debt instrument, what is your position? You are a lender to the organization.
Yeah.
You are a lender, right? So that's why we know the main advantages to the company when they advantages and disadvantages when they use equity capital and debt capital. We'll see quickly, and that we can analyze from investors' point of view, investors' point also, right? Because when we consider this equity and debt, there are some benefits to the organization. There are benefits to the investors for both, right? So when you consider these two categories, right? So then the objective is the maximization of shareholders' wealth. So in order to maximize the shareholders' wealth, organizations need to make several important financing decisions, right? In order to achieve this main objective of the maximization of shareholders' wealth, so they have to make important financing decision, right? And what is the first decision the organization should make? First of all, they have to decide where to invest. The first decision is investment decision, right? That means the organization should identify what are the profitable long-term investments, because the maximization of shareholders' wealth means a long-term objective. In order to achieve this long-term objective, there should be long-term investment. That's why we call capital investment, right? So that's why the first decision, the organization should identify the correct long-term investment, correct projects they have to identify. That's why, as you very correctly mentioned, we call it investment decision. Once the investment, the project, the capital investment identified, what is the next decision? To start this project, they have to
funds.
They have to raise funds. They have to raise funds. So that's what we call financing decision. To raise fund, as I mentioned earlier, right, as we discussed earlier, the company has two options. To raise funds, the company can use either equity capital or debt capital. Therefore, the way of financing their investments will decide the capital structure of the company. What is the percentage of equity? What is the percentage of debt? That will decide the capital structure of the company, debt to equity, right? So then the project should be selected, it should be financed, and what is the next decision? It should be continuously managed, right? But we know these three classifications, this classification into three decisions, right? We know in some finance books, these three decisions are explained as investment, financing, and dividend decision. Right? I remember. So you mentioned lastly, investment, financing, and dividend. So it's correct, but sometimes it is argued dividend is a part of financing decision, because once the company generate profit, they have to decide whether to distribute the profit as dividend or whether to retain and reinvest. Therefore, it's a part of investment, part of financing decision. It's a part of financing decision. So it is possible to identify, possible to decide whether to distribute or to reinvest. So that is financing decision, and after that, the company has to manage continuously. That's what we call short-term financial management or working capital management. Therefore, the three main questions the organizations have to answer: what are the correct long-term investment they should select, and how to raise funds to finance these investments, and how they can manage everyday financing activities. So that's why these three decisions are known as capital budgeting, capital structure, and working capital management. The capital budgeting, we know when company is going to accept a long-term project, because these are long-term projects, right, which will affect a number of years and usually involve very high investment cost. Therefore, before they accept, they need to do detailed evaluation in order to see whether the project is acceptable, right? Whether the project is acceptable, they need to evaluate. And so when they are going to evaluate, right, particular project, so they have to consider what are the benefits we can expect from this project and what is the cost that we have to incur, right? When we are going to estimate these benefits, this a decision entirely based on estimates. Entirely based on estimates. You all know very well, when your organization is going to consider a new project, they have rights to decide whether this project should be accepted. It is necessary to estimate what are the benefits that we can get from this project, what is the cost we have to incur for this project. These benefits we can estimate in number of ways. What is the best way to estimate the benefit? We can estimate the benefit in terms of, what is the measure?
Returns.
Returns in terms of what? Returns, how do you measure? How do you calculate return? Using what?
They are against the investment what we made.
Yeah, so you have to compare against the investment. I mean, return you can calculate, you can measure in terms of what?
Interest that you get, or the profits.
Interest,
Profits.
One thing is profit, right? So you can measure the benefit when the company start a project. What is the profit they expect for the first year, right? Based on their estimates, right? So they can estimate what is the revenue, expected revenue for the first year, expected expenses for the first year, and what is the profit. So that is one method, right? And so similarly for the entire period of the project, right? For the entire period of the project, right? So it is like this. So suppose the company is going to consider a project with let's say 5-year period, right? 5-year period, right? You can see this Excel sheet, right? You can see the Excel sheet?
Yes, can.
Yes.
Right. So now suppose one method, as you mentioned, we can estimate the revenue. We can estimate the revenue and expenses, right? Expenses. Then we can estimate profit. That is one method, right? That is one method. We can measure the benefits. What is the expected revenue for the first year? Expected expenses for the first year, and what is the profit? And if I put some simple figures here like this, right? So we can see what is the expected profit for the year, right? And based on that, right? So we can see what is the expected profit for the second year, third year, like this. We can estimate. We can estimate profit. One method is profit. One measurement of the benefit is profit. Profit, is it a very good measure to estimate, to evaluate a project? Profit?
Cash is better because profit can be manipulated.
Profit can be manipulated. Profit can be manipulated. In addition to that, what are the other issues when we use profit to evaluate and compare projects? Because company may get several project proposals. When the company gets several project proposals, if the company is going to select the project that has the highest profit, is it correct? Is it very correct
No,
to select the project with the profit?
No, not only the
It depends on the investment, no? The amount you have invested.
Yeah, definitely. We have to consider with respect to the investment, right? Suppose even if, okay, so let's consider company is considering several investment proposals that they have got for the same investment cost, but profitability will be different. So is it very correct to use profit to evaluate the project? You already mentioned one reason is not very correct. Why? Profit can be easily manipulated. In addition to that,
cash flows.
yeah,
Okay,
cash flows is the best thing. Cash flow is the best thing, right? Why?
Time value of money.
Okay, time value of money we have to consider whether we use profit. Yeah, so whatever the method we use, measurement, time value of money, that is very important point, right? Very important point. I mean, what are the problems of using profit? One thing, right, as you mentioned, it can be easily manipulated. In addition to that,
The profit can be there, but like if you put the same amount in the bank, you might get a higher return versus the profit that you get here. So it has to be over and above the bank returns or whatever.
No,
right.
actually, we can get the profit by earning the, we can get the borrowings. So for example, we get the fixed assets or whatever the things we can get from the bank loan, we can finance on a bank loan, then ultimately it can show as the profit. But you know, actually we have the high obligations and apart from when it comes to the balance sheet.
Right. Okay. So that is also one valid point. In addition to that, I mean, okay. So that is even when we consider only one project, right? So you mentioned what are the issues that we have to face, and especially when we compare different projects. When we compare different projects, what are the problems we can arise that we have to face? Because profit is based on what? Profit is based on accounting policies. So for different projects, the company may have accounting policies differently, right? So you know very well, there are some accounting policies, the management has the right to decide which policy to use, which can make direct impact on profitability. What are the accounting policies which can directly affect the profit?
Depreciation.
Depreciation. Right now, suppose two projects are there. The turnover, right, maybe almost same, but depreciation. One project, they may have a calculated depreciation based on straight line method. The other project, reduce imbalance method. Profit is different due to the depreciation adjustment. Depreciation is only one adjustment. There is no movement of cash, right? So due to the adjustment, accounting adjustment, profit is different. So which is not very correct. And in addition to that, in addition to depreciation, there are a number of other accounting policies, right? That can make
valuation of stocks, like first in
valuation of stocks. There are different policies where management can decide FIFO, LIFO, weighted average. So they have the option. So based on that, definitely profit will be affected. Profit will be different when the stock value change. Lot of provisioning there. The management has the right to decide. Provision for doubtful date, right? So many things. So profit will be affected. Sorry?
Asset disposals.
Yeah, asset disposals and this, right? So a lot of things can affect, right? Therefore, what happened? Profit is not the ideal measure of the benefit. So you already mentioned what is the correct measure. The correct measure is cash flows. Cash flows will not be affected due to the accounting policy. Whether the company use straight line or reduce imbalance method, that will not affect the cash flow. And cash flows not easy to manipulate, right? So the points you mentioned very valid. Therefore, one main principle in evaluation of the capital investment, the decision should be based on right. Cash flow is the best method because profit is not ideal method to evaluate a project, right? So we'll discuss what are the main principles of evaluation of capital investments, and therefore the first step in the capital budgeting decision is the estimation of cash flows. Right. So when we are going to estimate cash flows, there are a number of principles that we have to follow. Right. Sometimes there are certain cash flows that we have to consider. There may be opportunity cost. In addition to the actual cash flows, opportunity cost also should be considered. And we need to consider the relevant cost. There may be some sunk cost. Right. So when we move to this topic, we'll discuss in detail with all the examples. Right. So nothing to worry. I remember some of you mentioned you relatively new to finance, or some of you mentioned maybe totally new to finance. So nothing to worry. We are going to start from the beginning. Right, all the concepts we are going to discuss. Therefore, there are a number of principles that we need to follow when we estimate the cash flows. Once we estimate the cash flows, then we can evaluate the capital investments. Right? To evaluate the capital investment, there are a number of techniques. What are the techniques? Models we use?
ARR,
payback period,
IRR,
NPV,
and IRR. Right? So right, ARR, simple technique, accounting rate of return, right, ARR, and payback period, NPV, net present value, IRR, internal rate of return. All these techniques we'll discuss, right, with so a lot of calculations. And I mentioned, so you have to use a financial calculator, right? So you have to use a financial calculator for this module. When you use this financial calculator, the calculation of this NPV, IRR, you need only few seconds. You need only few seconds. Once we discuss the manual method, right, after that, we'll discuss how to do using this financial calculator. For that, you need only few seconds, right, to calculate this IRR, NPV, anything, right? Very easily, we can do that. Right. So once this, the company going to take this capital budget decision, need to estimate the cash flows, then they can evaluate the investment using these techniques you mentioned. Sometimes there can be situation, the company has number of profitable, acceptable projects, right? Number of acceptable projects may be there, but company may not be able to accept all the projects, right? So what is that condition? We call it capital rationing. We call it capital rationing. That means capital rationing is a situation where the company has number of acceptable projects. A lot of good projects are there, but company may not be able to accept all the projects. That's quite practical thing. So that's why we call it capital budgeting. Right? Why? Any period, a specific period, company has a budget. Capital budget. So you know very well, any organization, they allocate, they plan. For this year, this is the amount we allocate for capital new investments. Capital budget is there. Right? Therefore, if there are several acceptable projects, but if the company cannot accept all the projects, then what we need to do? We need to rank the projects. We have to rank the projects in order to select the best project. So that is called capital rationing. For that also we have some techniques. PI, profitability index. We can use the profitability index or IRR. IRR is a very useful technique, right? IRR is a very useful technique. Meaning of IRR, I think some of you, I remember familiar, but so those who are new, don't worry. These are simple calculations, right? Very simple, but very useful, right? And IRR, that concept we have to apply in number of places, in number of concepts we can apply. That's a very useful technique, right? So very useful technique. So we'll discuss the meaning of all these evaluation and rationing technique. Once the company is select the project, and as you mentioned, the next decision is financing. How to finance. Since the company can use either equity or debt capital to finance, that will decide the capital structure. That's why we call the capital structure decision. What are the different equity sources? What are the different equity sources? Equity capital sources?
Debt and the
It is
equity
shares.
capital and the debt capital.
Yeah, I mean equity,
Shares,
yeah, equity shares, mainly shares. Equity means own fund. Own means the owners, that means shareholders. So shareholders, there can be ordinary shares, there can be preference shares. Right? So what is the main difference between ordinary shares and preference shares? The main difference between ordinary shares and preference shares?
Voting power.
One thing is voting power, right? So ordinary shareholders, they have the voting power, but usually preference shareholders, they don't get, right? In addition to that?
Guaranteed interest or return?
Guaranteed dividend, right? Return.
Guaranteed
So because,
dividend, yes.
guaranteed dividend is there for which category?
Preference shares.
Preference shares.
Preferences.
For preference shares, there is a fixed dividend percentage. The fixed dividend percentage is there, but ordinary shares, dividend depends on the profitability and the management decision, right? The management has the right to decide what is the percentage of profit that should be declared as dividend. But the preference share, there is a fixed percentage of dividend which they agree. Sometimes some other options also can be included for these preference shares. There are preference shares with options like convertible, redeemable, cumulative, right? Number of other features can be incorporated to the preference shares, right? And okay, ordinary shares, preference shares, any other source for the equity capital? Normally in the balance sheet, you can always see another item under equity.
Borrowing,
Return
Owner's capital.
retained earnings.
Retained earning. Actually, all these things are owner's capital because shares, reserves, retained earnings, everything owner's fund. That's why you can see in the balance sheet these categorized as what? Owner's fund, shareholders funds, right? And retained earnings. So that is the other main item. In some organization, there can be some other reserves also, general reserves and specific reserves. They allocate from their profit for some special purpose, right? So these are the main equity sources. What are the main debt capital sources?
Bank loans.
Long-term loans can be there. In addition to that, there can be some debt instruments. What are the debt instruments? What are the main debt instruments? Main debt instruments are, right? So in many countries, corporate bonds there. Corporate bonds, that is a debt instrument. But so in our country, corporate bonds not there. So we have only government bond, treasury bonds, right? And but there is a debt instrument, long-term debt instrument used by government, used by companies in our country. That is called. What is the debt instrument? That is debentures, right? So here we have debentures. So therefore, what are the main debt capital sources? Bonds, debentures, and loans. These are the debt capital sources, right? So the company should decide whether to raise the capital required for the investment using equity sources or the debt capital sources, right? There are several options for the equity and several options for the debt. And whether company use equity capital or the debt capital, there will be a cost organization. That's what we call cost of capital, right? Cost of capital. What is the cost of equity capital? Company has to pay
Dividends.
The company has to pay dividend. What is the cost of debt capital? Company has to pay interest. When you compare dividend and interest, what are the benefits available to the company when they use equity capital? What are the benefits of using equity capital?
You don't have
The
to.
profits
It's not
are there
mandatory to
only.
pay dividends.
Yeah, the only profit, only if the profit there, the company has to pay dividend. Even if the profit there, company has the right to decide what is the percentage that should be paid as dividend. So which means dividend is not
obligation.
an obligation, right? Dividend is not an obligation. So that is the major benefit of using equity capital. The dividend is not an obligation. But when you consider debt capital, interest is obligation. Whether the profit is there or not, interest must be paid. That's why it's a fixed obligation to the company. Any other benefit of using equity? Any other benefit of using equity capital? Right? Not only the cost of capital, right? What about the capital, right? I mean, equity, once the company raise funds by issuing shares, is it necessary to repay capital?
No.
Company? Is it necessary to repay capital by the company?
No.
No need to repay capital, right? So when we buy shares, right, of a company, the company does not have obligation to repay the capital. If we want, we can sell the share in the secondary market. There is no any pressure to the company. The company need not to worry how to raise funds to repay this capital. The capital need not to repay. But debt capital, not only the interest, the total amount they collected, they have to repay. Capital also should be repaid. Therefore, companies should make sure they have continuous cash inflow to repay this capital. Because we know when the company take a loan, interest plus capital every right periodically they have to pay. Even these instruments same, right? Not only interest, at the end of the period they have to repay the face value. The total amount they collected they have to pay, right? Therefore, is another major benefit of using equity. No need to repay capital. Right? Then, when we compare these points, right, between equity and debt, dividend is not obligation, interest is obligation. capital need not to repay for equity, but debt capital must be repaid. One, right, can ask why company use debt capital, because that is the risk to the company, that is the risk to the organization, right? But here, when they use equity capital, there is no risk. Dividend company can decide and need not to repay capital. So one can argue the company, it's better to finance the entire operation using equity. No need to use debt. But can you see any company like that? So when you see the balance sheet, right? So is it possible to see a balance sheet that has only equity? Right? In any company balance sheet, you can see debt capital percentage or certain percentage of debt capital. Why is that?
Again, it's a decision-making thing, and so when it comes to the debt capital, it is already absorbed for the taxation, because tax will be calculated after giving the interest or the loan repayment.
Okay.
But the what you call the interest, the return on the equity, that is after creating the, after the profit, it will be calculated.
Okay, so that is one thing. So when we compare this cost of equity and cost of debt, the cost of debt, which is interest, is a tax allowable expense, tax deductible expense. So as you mentioned, the company get the tax benefit on finance cost, right? But when it comes to equity, dividend is not a tax allowable expense. Dividend is paid from the after tax profit, right? As you mentioned, the dividend should be paid from after tax profit. That means company does not get any tax benefit with respect to dividend, but company get tax benefit for the interest cost, because before they pay a tax, they can deduct the interest cost, and then the net for the net amount also, not only they have to pay tax. Therefore, that is one main advantage of using debt capital. Company get tax benefit on finance interest cost. What else? What are the other benefits of using debt capital? When you compare cost of debt and cost of equity, which one is relatively cheaper? Comparatively, which one is cheaper? Right? When you compare cost of equity and cost of debt, which one is comparatively cheaper?
Debt is comparatively cheaper.
Cost of debt is comparatively cheaper, right? Why is that? Because cost to the company means return to the investor, right? Earlier, as we mentioned, so you can invest in shares or you can invest in debt instrument. For example, debenture. So now we'll compare debenture and shares, right? So you have the option to investing in shares or investing in debenture, right? When we are going to invest your money, right? When you are going to invest your money, we expect a return, right? So always, whatever the investment we make, we expect a return. The return we expect for a particular investment directly relating to what? Directly relating to the
profits.
Profit means, the return we require. The return we require for a particular investment directly relating to what?
The risk that you take.
Risk is the factor. The risk, right, is the main factor. So that's why, in very, very simple terms. So suppose you are going to make a deposit. To make a deposit, you have different options. You can deposit with the commercial bank. You can deposit with the finance company. So if you are planning to deposit fixed amount, say 1 million, 1 year. So you can deposit with the bank, commercial bank, or you can deposit with the finance company. So do you expect the same return from these two institutions? Do you expect the same return? No. From which institute do you require higher return?
The finance
Commercial bank or finance company? Finance company. Why is that?
Their
Because
bad
of the risk.
reputation.
More risky, right? Therefore,
Bad reputation.
yeah.
Higher the risk, higher the return, is it?
Higher the risk, higher the
Higher the
risk,
return.
higher the return we require. Higher the return we require, because high risk means what? High risk means the return is volatile. Return is volatile. The return can change. That's why usually when we consider these investments in financial assets, what is the instrument considered as less risky? sometimes in finance markets, we use the term risk-free. What is that instrument?
Government bond.
Government, so government securities, because we believe, right, generally it is accepted. Why? Government will not default, right? Government will not default, right? So when we consider our country, so now the government bonds still, they have not defaulted. From the incorporation of the central bank in 1950, they have not defaulted any bill or bond, right? Yet they have not defaulted. That means they have some special rights the others don't have, other issuers don't have. That means if the government does not have money to repay these bills or bonds, normally government does not have money, right? They don't have money. So that means they don't have, money to cover the budget deficit. So then how can they repay debt? They can't repay debt. So because this government treasury bonds and bills, they issue to raise funds, that is their borrowing instruments. So that means they don't have money to repay treasury bills and bonds. Then how they, how do they repay without defaulting? Right? So they have not defaulted.
Their issue.
Yeah?
Reissue it.
They issue new bond and settle the old bond. They issue new treasury bill and settle the maturing treasury bill. So that's what they do, right? So every year, right? Not every year, every Wednesday, every week, there is a bill auction, treasury bill auction in the central bank, right? Because central bank is doing one agency function on behalf of the government. So one agency function is this public debt management. So there is a separate department, public debt department. So they issue treasury bill. So every week there is auction, right? There is an auction. So they issue new bills and settle all. And when bonds maturing, they issue new bond and settle all maturing, right? So any idea what is the debt liability in Sri Lanka now? It's total debt liability around. Any idea?
Some 29 billion, right?
29
Billion?
billion.
That's what I- Yeah.
29
Dollars?
billion rupees.
No,
29
dollars.
billion rupees. Yeah.
Dollars.
Dollars.
Am I correct?
Is it 29 billion?
Or 27 or something like that?
No, it cannot be because 83 billion USD only our total income.
Yeah,
is.
that's
So it's more
right.
than the.
It's
so
more
it
than,
will be
it's much
the
more than
extent.
that.
Yeah.
Now our debt liability is more than our GDP. Right?
Really?
So, yeah. So okay. So I can show you
Yes,
the,
that's right.
you
Yes,
can
correct.
see these values, because so if you go to this central bank website, right?
I think
So
the
when
issue
you-
is that we have to pay 29 billion this year, something like that. is what I
Okay,
think.
that may be the
Yes.
case. Now it's about $84 billion, right? In terms of rupees, that is more than 15 trillion rupees. 15 trillion, right? Not billion, trillion, right? So here we in the annual report there is a special section, special statistical appendix which has the information from the incorporation of the central bank from 1950, right? That has a lot of information, right? So population, national income, everything is there, right? Prices, balance of payment. This is the government fiscal operation budget, and this is the debt, central government debt. This is the total debt. The figures given in millions of rupees, right? Millions of rupees, and this is the total debt. You can see what has happened. So it has exceeded 15 trillion. 15 million millions, that means 15 trillion. The figures in millions, right? So 15 million millions there, that means 15 trillion. 15 trillion. And out of that, major part percent is treasury bills and treasury bonds, right? So out of that 15 trillion, 5.7 trillion treasury bonds, right? So then 1.6 trillion treasury bills, right? And when these bills and bonds maturing, or not only bills and bonds, even these foreign loans, when they mature, only option to raise new loan and to settle. That's the only option, right? So even to issue these new bills and bonds, there should be someone to buy them. So that's why they have now this central bank has to make it more strict to the primary dealers to participate. The participation is compulsory for the auction, and buying these bills and bonds compulsory, right? So otherwise they can't issue this. So therefore, but you may have heard, so when it is not possible to raise the total amount from these other private sector, the domestic and foreign sector. What is the last option? What is the last option? Right? Why these government securities are known as risk-free? Government has the right, they can, because if they cannot raise these funds from domestic or foreign market, what is the last option? They can
Borrow from private sector.
sorry
Borrow from private sector.
Print money.
Yeah, even if it is not possible or not enough from the domestic and foreign, all the parties, if it is not enough, what is the last option?
They can
Printing.
Declare
print more.
bankruptcy.
They have to
Print.
they have to print. They have to print money. The last option is printing money. So that's why, right? So you
Which is the only
You may
company
have
which is
heard
working 24
recently-
hours, isn't it?
sorry.
Which is the only company in Biagama working 24 hours at the moment, isn't it?
That's Dilaro, right? So actually, they are of course they are printing money not only for Sri Lanka. I think I have heard, because once there was a session at the central bank, so for more than 150 countries they print money. That's a big company, right? So the professor they explain. So printing money is the last option. Printing money is the last option. So that's why central bank is known as the lender of the last resort, right? Lender of the last resort, right? So you remember when we are studying in the school also, we, right, our school teacher taught us, right? 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 So the lender of the last resort. So that's why when this debt capital is very the government debt, right, reached to a very large, high level, that is the last option. So after borrowing from all the other sources, domestic and foreign sources, the last option is to borrow. The last option is to borrow from the central bank. So central bank, so they can use only by printing money. Last option, right? So that's why it is the last and also the worst option. Right, so you may have seen the countries that experience this printing money excessively. The countries like Zimbabwe, right? So you may have seen right few years back. So they have to print, because when this money supply increase, because printing money means money supply increase, but normally money supply should increase with what? Money supply should increase with what?
Economic activities, no?
Investments.
Domestic production.
Production. Money supply should increase with production, because right, the production and money supply should change proportionately. But when only the money supply increase, what happened to the, right? What is the result?
Inflation.
Inflation goes up.
Inflation is the result. Because because the available money supply should match with the available quantity. The quantity to production increase very, very slowly, but money supply increase at a very high rate. Then what happened is money supply and production should match. The result is inflation, as you mentioned. So that's why the inflation in Zimbabwe that time it reached to which level? Very abnormal level. It increased.
Skyrocketed.
Yeah. So the percentage was very abnormal, right? So it was the last the inflation rate published by the Central Bank of Zimbabwe during that hyperinflation period, 31 million%. 31 million%, right? Can't imagine, right? 31 million%. Right? And later it was revealed the correct rate is not 31 million%. The correct rate was, the correct rate was not 31 million%. The correct rate, the inflation rate was 231 million%. Later they accepted and published, and after that they republish. Right? So that's what happened. Right. Okay. So about the Zimbabwe case, so you may have a lot of information. You may have seen a lot of information in internet. Right. So now, so that's normally this treasury bill rate is known as the risk-free rate, right? But if those who are willing to take risk, as you mentioned earlier, they will move to more risky investment, but they require higher return. Because usually, right, normally, when you see the interest rate in the financial markets, treasury bill rate is the base that represent the best, the lowest interest rate in the economy, because that is the risk period. But when you invest in any other investment, you have to face some risk. Even when you invest in commercial banks, some level of risk is there. Therefore, you have to, you require higher return. And when you move to, right, those who are willing to take even a little bit higher risk, they invest in finance companies, as you mentioned, right? But they require higher return. But those who are willing to take even higher risk, they will move to unauthorized financial institutions. They will invest with sub-50, right? So those who are willing to take more risk, then they require higher return. So that's why this risk and return, two important concepts in financing decisions, right? Two very important decisions, the important factors that we need to consider in financing decisions, right? Then, the organization should decide whether to finance their operation with equity or debt, right? There are benefits of using equity, there are benefits of using debt. So as you mentioned, the investment in, the investment we make, we require return. The return we require directly related to risk. When we consider from investors' point of view, the investment in which category is more risky? Investment in equity or investment in debt? Which one is more risky?
From the investor's point of view.
Investors' point of view. From investors' point of view?
Equity, no?
Equity. Investment in equity is more risky. Because risk, as we discussed, risk means the volatility. Possibility that the return can change. Volatile, change. Right? So which instrument is more, return to which instrument is more volatile? Equity. Because when you invest in equity, sometimes you may get very high return. Sometimes you may get very low return because dividend highly fluctuate. So when you see the dividend of a particular company, 1 year very high dividend, 1 year very low dividend, sometimes no dividend, right? So highly volatile. But when it comes to debt capital, the return is not volatile that much because the interest rate is agreed. There is a definite time period for the instrument. So you can get the interest for that agreed period at agreed dates. Right? Therefore, the investment in debt capital is less risky from investors' point of view. The returns are not volatile. That's why usually these debt instruments are known as what? The debt instruments are known as fixed income securities. Right? Debt instruments are known as fixed income securities, right? Why? The return is fixed income. So you get a fixed interest rate for a given period. But equity highly volatile. So that is the other point you mentioned earlier. The cost of debt is comparatively cheaper. So that is another reason for the organization to use debt capital, right? So company use debt capital to get the tax benefit and to get financing at relatively low cost, right? To meet their financing requirement at low cost, right? And in addition to that, when the company use debt capital for new investment, it will not affect the ownership structure. We know, right? Organization, they don't issue new shares very often. Very rarely we can see new share issues. Why? Because if they issue new shares for each and every new investment, what will happen? Ownership structure will change continuously. But that, the existing shareholders will not happy. I mean, especially those who have the controlling power. Those who have the controlling power, they will not happy when the ownership structure change, right? Therefore, they don't issue new shares for new investment very often. Only, only very rarely they issue new shares, but usually they try to fight, when organization trying to meet their financial requirement for new investment, out of these various sources, what is the capital source they prefer to use first? Right. So here several sources are there. Several 6 categories have been included here. what is the first, preference for the organization? If they have a new investment, first of all, they prefer to finance that investment using what?
Debt capital.
Debt capital. First of all, debt capital.
Loans.
Starting, I guess you will have to have some owner's equity, no?
Yeah, let's say already started company, right? Already started company. What is the first preference?
Loans.
Usually they start with what? They start with
Retained earnings.
Retained earnings. Then they move to debt capital, and finally only they move to new equity, right? So, but usually the organization maintains certain capital structure, which they identified as optimum capital structure. Certain percentage of equity, certain percentage of debt. Therefore, continuously, when the firm is raising new funds, new capital, they try to maintain that capital structure, right? So we'll discuss later.
Just because there are retained earnings, it shows in the annual reports. It doesn't mean that entire thing is there, right? Really, because it's not equivalent to cash.
No.
Earnings.
Yeah. So that definitely retained earnings they continuously utilize. As you very clearly mentioned, retained earnings will never equal to cash, right? Because they continuous when they generate profit, when they retain, they reinvest, right? So therefore, that retained earnings will be reflected in number of assets in the balance sheet. Yeah,
will there be anything left in the retained earnings for you to invest in at any given time?
Exactly. Only the remaining amount can be invested, right?
Therefore, so won't that be shown in the cash in hand?
Sorry?
Won't that be shown in cash in hand? Whatever that is retained, if there is cash, will that be reflected in cash in hand in your balance sheet?
Yeah, cash in hand is one part of the retained earning, but retained earning certain major percentage may be reflected in other assets. Other assets they may have already invested. So
and retained earnings be at even the current assets or fixed assets as well.
Yeah. So it can be So it can be invested in both categories, right? Even non-current assets, current assets, right? The retained earnings will be invested.
Okay.
Right. That is the financing decision. After that, once the company decide how to finance, the next decision is how to manage day-to-day operations. So that is what we call the working capital management. The working capital management. So you know what are the short-term assets and short-term liabilities, right? Short-term assets means what is that category? You call it? Short-term assets means?
Current assets.
Current assets, right? It is current assets. And you know what are the main components under the current assets? What are the key components under the current assets?
Stocks and debtors.
Stocks, debtors. Stocks, debtors, what else?
Cash and equivalents.
Cash and cash equivalents. And another, one major category is there? Normally when we analyze current assets, under current assets, there are so many items, but 4 main items the company should continuously manage, right? You mentioned 3 important factors, right? Stocks, inventory, debtors, what we call trade receivable, then cash and cash equivalents, and another category is there?
Trade receivables.
Trade receivable, that is debtors, you already mentioned.
Prepaid expenses.
Okay, prepaid expenses, that's a small item, as I mentioned it. So there are, prepaid expenses, amounts due from related parties, refundable deposits, right? So these other items are there, but mainly for major items, stocks, debtors, cash and cash equivalents, and what is the other one? The company should continuously manage. The other one is short-term investments. So sometimes we also call it marketable securities, or you call it short-term investments, right? Normally, when the company is using this, maintaining these current assets, because current assets usually generate low return to the company. Therefore, when the company manage this working capital, major part of their current assets, they should invest in which category out of these 4 main categories? Major percentage better to maintain in terms of what?
Inventory.
Stocks, debtors, short-term investments or cash?
Inventory.
Inventory. Is it a good idea to maintain major part of the current assets in terms of inventory?
No, no.
No.
They
Right?
can go
Inventory,
for a
Obsolete.
short-term
investments.
Cash
short-term
and
investment. Short-term investment, right? Short-term investment, because usually current assets generate low return to the organization, right? What is the asset then that generate lowest return to the organization? Least return?
Cash in hand.
Cash in hand. Cash does not generate any return. Cash does not generate any return. And not only that, not only it does not generate any return, it loses value with the inflation, right? Therefore, the company should maintain only the required, right, cash level. So that's why companies should have cash budget in order to identify what is the required amount, right? So as you mentioned, major part of the invested in short-term investment. Right, so high stock or high debtors also not good. That's why in working capital management we calculate stock 14 period, debtors collection period. These things should be minimized. So the company should maintain minimum stock balance and minimum the debtors balance. Trade receivables should be minimized, and the major part of the current assets should be maintained, right, as you very correctly mentioned, in short-term investments. While meeting the liquidity requirement, they should be able to maintain good return. Otherwise, if they maintain, if they maintain these current assets more than the required level, they unnecessarily lose the possible return.
What are the short-term investments?
Short-term investments means, it can be short-term deposits, or it can be invested in treasury bill, or some short-term instruments like even some organization maintain their trading stock. Some organization they invest in shares, so that, right, but that also should be done with proper analysis, right? And so usually some industries like banks and financial institutions, there is a statutory requirement to maintain liquidity.
Excuse me.
Liquidity ratio should be maintained. Yeah.
Will it be considered like forward exchange also as a short-term investment?
Forward exchange means, so that means they are actually,
yeah, like say we can invest on dollars in terms of short term. We can turn into the rupees, like getting the exchange rate gaining.
Yeah. So that again requires, so sometimes, so in foreign exchange market we learn, like, this parity relationship, and whenever there is, as you mentioned, whenever there is a possibility to make a profit, but there are several strategies we learn in this foreign exchange market. Like, sometimes we have to speculate. Speculation always involves risk. Sometimes we get the gain, sometimes we lose.
Yes.
Therefore, there we have to take the risk, speculation. But sometimes if you identify profitable opportunity, right, without risk we can earn, that is called arbitrage, right? So that also we can consider. Right? So that also some investments, certain investments involve risk, speculation, right? So that is one reason to maintain cash for the organization normally, even though cash does not generate any return to the organization, because any organization cannot have zero cash balance, right? Cash does not generate any return, but all the organization need to maintain cash. Why is that?
Because it need to be run, function day-to-day business to be run.
Day-to-day business. So that is what you call transaction. To meet day-to-day transaction, we need money, transaction demand, right? What else? To meet any unexpected payments, we need to maintain cash, right? So we call it precaution. The other thing, as you mentioned, right? As you mentioned, whenever there's opportunity in the market to make profit, to utilize that, cash should be maintained. That is called speculation. Transaction, precaution, speculation. Right? I even remember we learned this in our school, right? Ape Mallika teacher kuwe mudalata adi illu. Garudenu chetanawa, arakshana chetanawa, samapekshana chetanawa kiyala Mallika teacher, right? So same points: transaction demand, precautionary demand, speculation, speculative. Right? So to meet these requirements, it's possible to, right? It's necessary to maintain cash. So that's why working capital management is important, because this can make direct impact to the profitability of the organization.
Now a
Right,
company
so
like
which-
company like Coca-Cola or Unilever, let's say like what are the short-term investments that they can do? Because like
you know that actually for any organization, once they identify, right, as I mentioned earlier, one strategy used by many organizations, they prepare cash budget. Once we prepare the cash budget, it's possible to identify whether the company is going to experience cash surplus. If we identify the company is going to experience a cash surplus, we need to see whether it is a short-term surplus or long-term surplus. And based on that, the investment can be made. So if it is a short-term surplus, so we have to, we can invest in some short-term investments like, so if you, as you mentioned, so we can see what are the types of investments they have made. Right, like usually many organizations, they invest in treasury bills because so while they meet their liquidity requirements, right, while they meet the liquidity requirement, they can earn a return. Right, so now what are the companies you mentioned? Coca-Cola and
Unilever.
Right.
They are big multinational. Generally, they don't participate in the local stock exchange or whatever.
Yeah. That's right. So it is not listed in the Colombo Stock Exchange. Yeah. Right. That's right. Yeah. So now you know, now most of the companies, when they consider this investment in short-term assets, they mainly so that means once they identify surplus funds, they make some short-term investments, even bank deposits, and sometimes some organizations maintain trading stock, which they can quickly convert to cash. So then they can meet their liquidity requirements. Right, but they mainly use very actively traded securities, like those who have, you know, the companies that has very good secondary market transactions. So companies maintain this short-term investment in different alternatives. Right, so then you know what are the main current liabilities? That means the short-term financing sources like creditors, short-term loans. This commercial paper is an instrument which is similar to treasury bill. A treasury bill issued by the government with the government guarantee. This commercial paper, these are the instrument issued by big organization, right? So we call these blue chip companies. So commercial paper, short-term instrument, debt instrument, right? And in addition to that, they can use this some short-term facilities like bank overdraft. So this working capital management means the short-term financing management, right? So that is the main overview of this module, right? So we know organizations need to make this investment, financing, and short-term financial management decision, right? And so this is what we are going to cover in this module. But you know, this working capital management is simple area which include only the details related to 1 year. That does not include financial mathematics. But when we consider capital investment, right, the capital budgeting and capital structure decision, right? For example, now if I use some figures here, you know, cash inflows and the cash outflows, right? And if we calculate the net cash flow for different investments, right? Say, right, I will put a very simple example like this. Now, suppose there is a project like this. Right? There is a project like this. The investment required for this project, the investment is $450 million, and these are the expected net cash flows for the project. This is the investment cost, 450 million. These are the net cash inflows expected from the project over the life of the project. If the project has a period of 5 years, this project, is it acceptable or no? Very simple example I put here, the simple figures, right? This is the investment cost. These are the expected net cash inflows, the net cash inflows. This project is acceptable or no? This project is acceptable or no?
Showing positive cash flow, net cash flow,
Yeah.
but it's taking 5 years to pay back.
Right.
So is it a decision you need to make? Because anyway, it doesn't give you the discounted factor. So you really don't know whether currently the net present value, whether it's worth it. That's what
Right.
to be checked.
Okay, that's right. Because this investment cost, we can't simply compare with the aggregate of these cash inflows, right? We can't simply add these 5 figures and say this is the total inflows we expect and this is the outflow. And can we compare that way? Right? Can we compare that way? This is the outflow and the total inflows, this one. Therefore, right, is it possible to say that therefore it's better to accept this project? Is it possible to compare these 2 figures? 500 is the aggregate of these 5 figures. Is it possible to act like that? Is it correct? Is it correct that these 5 net cash inflows?
No,
That is not correct. Why?
it's a future cash inflow.
Because
that-
these
that's the
are
present
the
value.
cash flows at different time period. This is the cash flow we expect for the first year. This is the cash flow for the second year, right? We expect in 5 years. And this is the cash flow we have to incur today. When we compare the investment that we have to make today and the return we expect in future periods, that is not correct. That is not correct. It is not possible to add these figures directly. Even though these amounts same, this value also same. Value of these different cash flows is that same?
No.
It's not same. What do you call it? What do you call it? That is what we call. That is what we call in value of money, right? We need to see what is the value of this 100 in today's terms, right? What is the value of this 100 in today's terms? Because this is the value we are going to get in, right? This is the value we are going to get in 1 year's time. And what is the value of this 100 that we are going to get in 1 year's time? Today's term. That means what we have to do? What we have to do? We have to calculate what? We need to calculate the
Depreciation?
okay, depreciation. What is the move, right? So depreciation that will mainly
NPV, present value.
okay. So once we calculate the overall one, we call it NPV. Right now, we have to calculate what? We need to calculate the value of this 100 in today's term. Today's value. Today's value means, right? So you mentioned the final answer, net present value. To calculate the net present value, right? So we have to calculate what? We need to calculate the present value of these inflows, right? And then we need to get the total present value of inflows. And from that, we need to deduct the outflow. Then we get the net present value, right? Therefore, all the cash flows we should measure, should analyze in today's term. Because the 450 that we have to spend today and 100 we are going to get in 1 year's time, 2 years' time. So can we compare? It's not correct. That is not correct, right? So when we spend 450 today, we need to see what is the value of these benefits that we are going to get, right, from this project in today's term. We need to calculate the present value. To calculate the present value, what you need to do? You need to, right? Calculation of present value means what? We adjust what? We adjust the time value of money. We call it, what is the time value of this money? This is the cash flow we are going to get in 1 year's time. What is the value of this cash flow in today's term? That is what we call time value of money. How do you adjust the time value? You know why these amounts are different? time value of money. We call it time value of money. What are the factors affecting to the time value of money? Right? What are the factors affecting to this time value of money?
Is the time value of money is equivalent to NPV?
No, to calculate the NPV, we adjust the time value of money, right? So time value of money is the fundamental concept that we use in financing decision. NPV means, right, after we adjust the time value of money, right, over the financing decision, we need to adjust the time value of money, not only NPV, right? So calculate the NPV also, we adjust the time value of money, right? All the financing decision, when you are going to calculate the price of a bond, we adjust the time value of money. Price of a share, we adjust the time value of money, right? The time value of money is the fundamental concept in finance. Any financing decision which involve the amounts at different time periods, we need to adjust the time value of money. We can't simply compare this 450 and these amounts we are going to get at different time periods. We need to take all the cash flows into one point. All the cash flows we should analyze in today's term, present value. Why these amounts are different, right? What are the reasons for this time value of money? Why is 100 in the first year and 100 in the 5th year different? Why is that?
Inflation.
One thing is inflation. One factor is inflation. Due to the inflation, what happened? What happened? Which one is more valuable? 100 in the first year or 100 in the 5th year?
First year.
First year.
First year, right? Why? With the inflation, what happened? The value of money decrease. When inflation increase, the value of money decrease, right? And with respect to, this the term currency depreciation, we mainly use with respect to foreign, when we compare with another currency. Now, for example, when the exchange rate of Sri Lankan rupee with another currency, right? When the exchange rate increase, when we have to pay more rupees to buy one currency, we call rupee depreciate, right? So now, but this one, currency value decrease due to inflation. Inflation is one thing, right? Inflation is one point, right? What else? What else? Why this 100 today is more valuable than 100 in 5 years? If you receive this 100 today, what you can do? What will be the value of this 100 we are getting today, 5 years? What we can do? Okay?
You can earn.
You can earn, you can invest. You can invest. We have the earning power, earning capacity. We can deposit this. The value will be much more than 100 in 5 years. In 5 years, it earn return. So we have the earning, capacity. Earning capacity. And then you mentioned another important point, inflation. Another important point is inflation. So, right, why the amount we receive sooner, more valuable due to its earning power. And when inflation is there, the value of money decrease when the time increase. Therefore, inflation is another factor affecting the time value of money. What else? In addition to these two, uncertainty. The other thing is uncertainty, risk. The other thing is uncertainty, risk. If we have the option to receive 100 in the first year or the 5th year, we prefer to receive it in the first year, right? We don't know what will happen in 5 years' time. Uncertainty, risk. So due to these factors, the cash flows at different time periods, the value will be different. That is what we call time value of money, right? So that is what we call time value of money. Therefore, all the financing decision, we need to adjust the time value of money, right? Time value of money, these factors we can incorporate into one number, because this is money has, the value of money will be affected due to timing of this cash flow. What is the price of money?
Interest.
What is the price of money?
Interest.
Interest.
This is the price of money. This is the price of money. Therefore, all these factors we can incorporate it into one figure. We can incorporate all these factors into one figure. That is the interest rate, right? we can, we can adjust the time value of money using the interest rate. Interest rate is the price of money. So if you give your money to another party, the price you expect is the interest. When you borrow money, the price you have to pay is interest. Therefore, interest is the price of money. Interest rate is the price of money. So time value of money can be adjusted using interest rate. Therefore, all these financing decisions, right, involve money, and timing of these cash flows, right, should be adjusted. Therefore, time value of money we need to adjust, and these decisions involve risk. We require return. Risk and return are the two important concepts that we have to consider in financing decisions, right? So when we analyze financing decisions, the two very important factors that we need to consider are risk and return, right? Risk and return, right? So you already mentioned the relationship that should be maintained, right? We consider this risk and return. When we consider high risky investment, we require high return, right? So risk and return are the two important concepts that we need to consider in financing decisions. Therefore, risk and return we are going to analyze with respect to individual assets, right? With respect to individual assets, and right, risk and return we are going to discuss with respect to individual assets. And not only that, we know as a rational investor, so when you are going to invest your money, you prefer to invest in one asset or number of assets?
Number of assets.
Number of assets, right? So anyone knows that very simple saying which explain the risk, right? So don't put all your eggs in one basket, right? Based on that, any rational investor will invest in number of assets. Therefore, we need to know how to analyze the risk and return, not only for individual asset, for portfolio. Therefore, we are going to discuss about portfolio management also. Right, portfolio management and model used to identify whether these assets have been priced properly. We call it capital asset pricing model. We are going to discuss about portfolio management and capital asset pricing model. CAPM, very commonly known model in finance. Capital asset pricing model. Because these finance decision, you can see financial assets are there. So these ordinary shares, preference shares, bonds, debentures, we call them what? We call them financial assets. Financial assets. When we consider these financial assets, these financial assets have number of differences when you compare to the real asset. What are the main differences between financial assets and real assets? What are the major differences between financial assets and real assets?
Tangible.
Okay, one thing is, okay, real assets tangible, but financial assets intangible. That means when you buy financial assets, you don't get anything, right? When you buy real asset, maybe a building or a vehicle or some other equipment, machinery, you get something tangible, which has physical value. But financial assets, when you buy shares or bonds, what do you get? What do you get? You don't get anything. Nowadays, you don't get even certificate, right? You don't get certificate also. Right? So now they use totally automated system. Central bank, when they issue treasury bills and bonds, what is that system? It's called SSS. SSS. That means scriptless securities and settlement system. Scriptless. No papers now. Scriptless. Right? Sorry.
This, time value of money. The best industry that they manipulate the people are the insurance, right? They take money today and then start paying after 15 years.
Right. Manipulation means, it's not possible to manipulate. That means when we know, that means manipulation means we can identify what is the return we are going to get. Then only we have the right to decide that. That's why actually in any industry, those who are trying to sell their product, they will give the, you know, the best to the customer. Right? Some industries, they will show you everything is optimistic. Some industries, to get their business, they will mention everything pessimistic. In insurance, right? No, life we not sure, right? So everything they will tell pessimistic. But when you consider lottery board, everything is right, optimistic. So you become multi-billionaire within one night. So they, right? So in any industry, they will try to sell their product, but we have the right to decide whether we should buy the product or not. So insurance also same. Insurance, as you mentioned, so today we have to pay the premium. Okay, that's very good. You asked that, right? Because here we are going to do some lot of calculations here to adjust this time value of money, so that you can decide whether it is a good premium to buy, good investment policy to buy, right? Good investment policy there that we have to decide, right? So when they mention, okay, this is the amount that we have to pay today, and this is what you are going to get, right? In right when you reach 60 or when you retire, so whatever. So then we can see what is the amount we pay today, what is the return we are going to get. All these things can be calculated easily, right? So we'll see. We are going to do that. We are going to do that, right? Therefore, time value of money, we need to adjust, right? So that is a very good example you mentioned, right? So one particular financing decision. That's why I mentioned earlier, like last day also I mentioned, the concepts you learn in this module, not only it is important for you personal.
So sometimes your voice kind of fades in and out. We can't hear you at times.
Perfect.
Yeah, there is a hum actually. There is a
80% of the time very clear, 20% of the time it fades in and out.
Right.
I get a very bad hum. There is a noise, like echo kind of. Maybe somebody has logged in with 2 devices or something like that.
Yeah, that happens if some people are using 2 devices.
All right. Yeah. So sometimes, so when you the other thing, when you have to when you want to ask a question, anytime you can unmute and ask. Other time you can mute your mic, so then that also will make it more I think clear. But I always encourage you to ask question, right? So it's necessary to ask question, otherwise it's difficult, right? So please ask a question and give your comments, ideas. So it's so important, as I mentioned last day also, right? So I expect you will switch on your videos when possible. So it should be right. Sort of classroom environment should be there. Otherwise, it will be very difficult. So I want you to discuss, right? But when we do the class in this format, we have a lot of challenges. If it is a physical class, it will be much better and interesting, right? But so here I try to make it as interesting as possible, so that right. But so I need your help for that. And so as you mentioned, so whenever there are some these technical issues, please tell me, because I try to maybe explain it again, right? So these issues arise, right? So I mean, okay. So this time value of money, lot of practical problems, practical questions we'll discuss. And I think I mentioned last day. So here, this study text. Did you get the study text?
Yes.
Right. So this study text.
But what you are teaching right now, it is not on the study text at all. So how do we get this presentation before the?
That will be uploaded to the you have that.
I think
so you get
the learning portal, right?
Yeah.
So I don't think we have got the password for that yet.
Yeah,
yes,
but
you will get the access. You will get the access.
Yeah, if we get it beforehand, so that we can print it and make notes then and there. Because right now we have to write everything, actually, most of the stuff.
Right. Actually, maybe since these the first 2 or 3 weeks. Otherwise, so they will upload everything in advance, right? Because for certain topics, I will give some additional material also for you to refer, to make it more clear. So everything will be uploaded in advance, right? So that you will get all these things. So in this study text, a lot of practical issues, as you mentioned, insurance, retirement planning, loans, right? Very practical questions are here included, right? So yeah, a lot of questions are there, very good questions, right? So any business and personal financing issues can be analyzed easily, right? So when we discuss this time value of money concept, that's why when we are going to do this before we start these key topics, that's what I try to explain now, right? We need to know how to adjust this time value of money. Time value of money, to adjust that, we have to use number of interest rate concepts. Therefore, at the beginning, right? At the beginning, before we move to this key topics, we are going to discuss financial mathematics. Right, so we are going to discuss important financial mathematics concepts. Right, so you will see a lot of important financial mathematics concepts we are going to discuss at the beginning. Right, financial mathematics concepts. First, to adjust this time value of money, we have to use interest rate concepts. Right, we have to use interest rate. Right, interest rate can incorporate all these factors: earning capacity, inflation, risk, uncertainty. Everything can be incorporated into the interest rate. So interest rate, there are a number of interest concepts, right? So I think you may have heard, you may have applied, some of you, right? You may have experienced like simple interest, compound interest, effective interest, real interest, continuous interest. Number of interest concepts are there. Therefore, first of all, we are going to discuss about these financial mathematics concepts, right? So then we can, these financial mathematics concepts probably the most important part of this module. Because when you understand these financial mathematics concept properly, it's very easy to discuss other topics. All the other topics you can easily understand, right? Because all the financial management topics based on these financial mathematics concepts. Therefore, at the beginning, we'll discuss these financial mathematics concepts, right? So I know, right? Then we'll do all the questions at the end of this chapter, right? Then you can say it's so easy to do these calculations, right? And did you manage to get the calculator?
Not
Financial
yet.
Yes.
Not yet, sir.
Not yet.
Right. Okay. It's better if you get the financial calculator quickly, right? Then because you will see with the financial calculator, these calculations so easy, right? Very easily we can do, right? But all the calculations we are going to discuss the manual method also. All these calculations we can do manually, right? Because we should not totally depend on financial calculator, right? Because one day when you have to do one of these financial calculations, if you don't have the financial calculator, we can't say, right? Today I can't, I will get the financial calculator tomorrow, right? We can't tell like that. We should be able to do that, right? But financial calculator help us to do this module easily, right? And that gives us the opportunity to discuss more, because a lot of calculations we can do quickly within few seconds, right? So which gives us the opportunity to discuss more, right? That's why we start from the very beginning of this module, but we are going to cover, right, up to which covers under any professional finance exam, right? Therefore, once you complete this module, right, so you will be able to analyze, right, so very advanced finance issues, right, easily. Okay. So the points I discussed so far, is that clear for you?
Yes.
Right. Any point, any question you have, you can ask anytime, right? Anytime you can ask any question. Right. So what about others? Others, okay?
Yes, so far so good.
Right. Okay, so it's important to understand from the beginning. Therefore, you can ask anything, right? So you call me Sanjeev, right? So I prefer, so when you call me Sanjeev, I go Guruge, right? So my name Sanjeev Guruge, right? So my friends of course had some short versions also, but you can call me Sanjeev, right? Guruge, no problem, right? So you can ask any question at any time, right? So usually, right? So we can start now financial mathematics. Usually this 3-hour class, so we get a short break. Maybe after 1.5 hours, so 10 to 15 minutes break, right? So any questions so far? Any questions? Others understood? Right, as I mentioned the other day, so if there is any issue, right? So if you feel it's not very pleasant to tell me, you need to tell Kapila or the other people at office, right? So otherwise, I normally ask them to take evaluation, not at the end, because at the end taking evaluation, no point, right? So it should be taken after at least 2-3 sessions to see whether it is okay, right? So let's take a break then. So if it is okay, so let's take 10 minutes break, and after that we'll start with financial mathematics concepts.
We come back at 8:20.
Okay. So let's.
So can you just tell this calculator model again, if you don't mind?
Yeah, it is actually sorry. It is FC100V. I'll show you.
So can you put it in the chat box?
Yeah. I'll show you the. This is the calculator.
Is there any alternate models?
So many different financial calculators are there, but the steps that we need to follow, these functions are different, right, from calculator to calculator. Therefore, if you use different financial calculators, it will be very difficult, right? And but this financial calculator very user friendly, right? Because I have used another financial calculator earlier, but that's much more complicated. But this one so easy, very easy to do the calculation. It's FC100V or 200V. This Casio FC100V or 200V. These are the calculators recommended for this module, because most of the calculations are based on this calculator. Because some other financial calculators there which are much more expensive, right? But certain functions are not hit there, right? Because here even some calculations like expected return and standard deviation. Standard deviation, so here stacked calculations are there. Some financial calculators not there. But here, when these standard deviations can be calculated in few seconds. So very good financial calculator.
Hope you will do a lesson on the calculator as well.
Of course, for each topic, each function, I will explain in detail, right? So therefore, step by step. So you need to familiar with the financial calculator. Then you will see. In fact, I don't know whether I mentioned the other day. So this will show you. It's so easy to do this calculation, right? I think I didn't mention last week, because when I start this program in 2013, in fact, I started in the middle of one program. So then, as soon as I joined, there was a graduation for the previous batch, right? So then Kapil asked me also to come. I just participated, but those who from the previous batch, right? Then, so after during the graduation, they asked one person who got the qualification also to deliver a speech. And that person, he came to the stage and he said, before I start this program, I thought finance professionals are doing a big job. But after starting this program, I realized it is not the finance people, but the calculator is doing the job. So that is what he said, right? But after that ceremony, after that graduation, everyone was blaming him, right? Move up your camera, right? It was
We the
He
sales
is-
people, we use this, like, this is like big calculators, just.
Yeah. But the other calculators, that does not include these finance functions.
Yeah, nothing.
Yeah, but you know that statement was not correct due to several things, because financial calculator do the calculation easily, but only if you identify the inputs correctly and insert. You know, calculator does not recognize the inputs, so you need to identify the inputs correctly. So then calculator will give you the answer. So we need to understand the issue properly. We need to identify the variables correctly. Then only we can get the correct answer. Right? So we should not totally depend on the financial calculator. But I think I mentioned this exam paper for this module has been designed to answer with the financial calculator, because it is almost impossible to answer within 3 hours without financial calculator. So that's why I mentioned it's better to get the financial calculator as soon as possible. So we'll you know, step by step, we'll discuss all the steps in this, right? So that you can do easily. Okay, then let's take a break.